Hi, my name is Keith Dreyer, and I am honored to serve as president of the Shils Fund. Thank you for being here. The Shils Fund is named for the late Dr. Edward B. Shils and is a nonprofit organization dedicated to innovative approaches and entrepreneurial leadership to advance oral health. Dr. Shils was the executive director of the Dental Manufacturers of America, the Dental Dealers of America, and a professor at the Wharton School at University of Pennsylvania. Ed was an innovator, educator, and business leader with an unparalleled entrepreneurial spirit and saw a need to encourage more innovation and entrepreneurship at every level. Through investing in and championing awards programs, the Shils Fund recognizes outstanding individuals, organizations, and programs that influence the oral health community. Last year, the Shils Fund celebrated our 20th anniversary and pivoted to cultivate a new, diverse generation of oral health entrepreneurs. After the successful launch of our 2022 Shils Partnership Awards program, which awarded $5,000 to 4 oral health entrepreneurs who displayed innovative oral health ideas that advance oral health and its link to overall health, we have expanded upon this program by providing a hands-on, personalized approach and educational platform. I hope you received the news recently about the launch of the new 2023-2024 programming, The Great Oral Health Pitch: Innovate, Elevate, and Generate Your Idea to Advance Oral Health. Through a series of educational webinars and in-person nationwide practice pitch events, we are providing an educational environment to help entrepreneurs elevate their innovative ideas into a successful pitch with the goal of being selected for the Shils Partnership Award. The webinars are designated to educate students and entrepreneurs with best practices from top leaders in the oral health care space. These webinars will cover current topics in oral health innovation and entrepreneurship and address the changing needs of the oral health industry. So welcome to our first webinar, Path to Practice Ownership. This webinar will highlight the benefits of being a practice owner versus associate, the profile of a successful first-time practice owner, the process for purchasing a practice, starting up a practice, what banks look for to say yes to a loan, and what a loan should look like for you. Our speaker today is Jonathan Burns, Senior Vice President of Bank of America Practice Solutions and board member, treasurer of the Shils Fund. As division executive, Jonathan leads the business development team that serves the small business lending needs of healthcare practitioners in the Southeast. In addition to his team, Jonathan manages the corporate partnerships practice solutions in the Southeast. Previously, Jonathan was a business development officer. During his career with the practice solutions team, Jonathan helped to form and grow partnerships with many state dental associations. Jonathan grew up in Ohio, lives in Tampa, and has been in the financial services industry since 2005. After today's presentation, you will have an opportunity to ask questions. Please type your questions into the chat box so our speaker can address them. Welcome, Jonathan.
Well, thank you, Keith, and thank you all for joining us today. I appreciate the opportunity to spend a little bit of time with you. As Keith said, at Bank of America Practice Solutions, we are very passionate about practice ownership and entrepreneurship in dentistry, and I'm honored to be part of the Shils board, as Keith said as well. So I'm sure many of you are probably familiar with Bank of America. One of our slogans is we're better when we're connected. And so one of the themes that you're going to hear throughout the presentation today is this idea of connectivity in your industry and what that does to help you through your journey to hopefully owning a practice. And to give you a little background, obviously I'm sure everyone's familiar with Bank of America. You may not be familiar with Bank of America Practice Solutions, and so I'll give you a little additional background on who we are. We're the boutique division of the bank that specializes in healthcare practice finance. We happen to have been in business for 26 years, and we also happen to be the number one healthcare lender in the country. So every year, Last year alone, we helped over 1,000 dentists start new practices, and an additional 1,000 dentists purchase their first practice across the country. And so we feel blessed to be able to really help the industry the way that we do and we have. That's a little about who we are. In addition to that, we have 45 regional business development officers across the country that are there to help you in person with your needs if you're considering opening a practice. And all they do is work with dentists just like yourself who are looking to, or prospective dentists who are looking to get into practice ownership. So, all right, so here's the agenda for the day. The first thing we're going to talk about is really the benefits of ownership. Why should you be an owner? I think this is a common thing you're probably hearing, whether you're in dental school or you're working as an associate. There are different opinions on whether you should own a practice or you should continue to work as an associate. So we'll address that right off the bat. After we get done with that, we're going to go through the profile of what a first-time owner looks like. And then we'll talk about the process for purchasing a practice, the process for starting a practice from scratch. Finally, we will get into credit and what a bank is looking for when we want to lend. We will look at what a loan should look like. And then finally, we will talk about what you should be looking for when considering a financial institution to help you with this process. So let's get going. All right. So benefits of practice ownership. I'm just going to work from the left here. You know, I think one of the things, whether you're associating currently or you're in dental school, that you may not consider is that when you work as an associate, typically the people that you're working for, whether that be a DSO or another dentist, you're typically going to have a structured day. They're going to structure the day for you. As an owner, you have the ability to structure your day, and that tends to be a big benefit, especially depending on your family situation. When you own your own practice, the ability to be able to structure your day, if you want to drop your son or daughter off to school and pick them up again in the afternoon, as a practice owner, you have the ability to do that. You can schedule around that. As an associate, you do not. You know, the reality is that you're at the mercy of the person that you work for. So that's the first benefit. The second benefit, building a legacy and an impact in your community. Can't ever stress this a lot. For many of you, if you're a dental student, this may not feel like a big thing, but as you get older and further into practice, having that legacy and the impact you make on a community becomes really an important thing. And as a practice owner, you get to reap those benefits as opposed to working for someone else. Next huge benefit is the ability to control your industry. Obviously, one of the things that we hear quite a bit is that the word DSO, Dental Services Organization, or these large corporate groups. And while that may be the right path for some and maybe not the right path for others, the reality is when you own your own practice, you control your industry as opposed to large corporations controlling your industry. And so it's definitely a benefit, and long term gives you the ability to really control what's happening. Finally, business equity position. We're going to talk a little bit more about that here in a second, but it's a huge benefit. When you own a practice, you have equity in that practice. If you ever were to sell, or when you sell, I should say, is the better question at some point. And then finally, to illustrate kind of what the business equity position is and take it one step further, we're going to talk about what I call the rule of 50. Let's talk a little about that. So really what the rule of 50 is about is just to give you an idea of what the earnings power of being an associate versus an owner are over the course of time. And so here, the first illustration you're seeing is just a round illustration of what an associate would make. So producing as a general dentist on average $50,000 a month, that means you're producing $600,000 annually. And you're paid somewhere around 30% of collections. Again, I know that depending on where you work and who you work for, your collections could be higher, they might be a little bit lower. But on average, 30% tends to be a good number. So within that, you're paid 30% of collections, you're bringing home $180,000 in income, not a bad living at all. And when you're taxed at 30%, your net income is $126,000. Again, not a bad income. As an associate, I'm sure many of you, if you're sitting in the position of a fourth year dental school, you're saying, oh, that sounds great. I'm looking down $300,000 or $400,000 of student loans. $180,000 a year would help pay those. So next, let's take a look at the difference in what an owner would look like producing the same amount in a general dental practice. Again, these are, for our purposes, we're going to be looking, most of what I'm talking about is going to be general dentist as opposed to specialist. But I'll do my best to make some comments around if there are any specialists in the room. So as an owner, producing $50,000 a month, $600,000 annually. The difference, though, the total revenue of your practice is $900,000. The reason that is because hygiene. On average, 33% of your practice as a general dentist is going to be hygiene. Again, that number can change. It can go anywhere from 25% to even 40% in some cases. The average dental practice has a 40% profit margin. So at $900,000 in total revenue, doing the same amount as an associate, you would be bringing home $360,000 after you pay the loan. So assuming you take out a loan to buy that practice, you would be at $272,000. And finally, when you tax that at 30%, that leaves you with $190,000. Pretty big chunk of change when you consider the difference of doing the same thing as an associate. But for many of you on the call, you might say, well, yeah, that's great. It's whatever, close to $75,000 more, 60 and some change, but it doesn't seem like a huge benefit. So why don't we go ahead and take it one step further? So this is the 10-year difference. As an associate making $126,000 annually after taxes, that's $1.26 million over 10 years, no equity position in the business. So after 10 years of working as an associate, you have $1.26 million. Okay, as an owner, you over 10 years making $190,000. That gives you a total earnings of $1.9 million and change. And by the way, over that 10 years, you completely paid off your loan to the bank. And so now you have a business that's worth roughly $720,000. So you add up the 1.9 and the 720. Guess what? Over that same 10 years doing the same amount of production as an owner, you would have had a net worth and made $1.367 million more than you would as an associate. And so I go through this to simply just show you the difference between an associate versus an owner, what that looks like over a 10-year period. I think there's a lot of common myths, especially when you're in dental school. You'll hear and have people talk to you and talk about, being an owner isn't all that's cracked up to be. You can make as much money being an associate. Well, hopefully this illustration gave you a little bit of an idea of what the difference of being an associate versus an owner and what that really could be over 10 years. Okay, moving on. Next, we're going to talk a little about what the first-time practice owner profile looks like. I like to go through this simply because I think a lot of the dentists I worked with over the years always have a kind of a misconception around what they need to look like to qualify. They think that, I need to have a 900 credit score. I need to have $400,000 in the bank. They have all these different misconceptions. And so I'd like to review this. And so we'll start from the top here. So associate work history. Our typical client is coming to us between 1 to 5 years out of dental school. That's right. And so previously, when I first started in the business back in 2008, dentists used to, the average was 3 to 7 years, and now it's getting even faster. We're seeing associate doctors that are interested in practice ownership quicker than we've ever seen. And so right now, our average work history is 1 to 5 years. And we, just so you know, as a bank and as a lender that specializes in your industry, we will lend to a dentist who has only been out of school and working for 12 months. So that's kind of the first thing that I like to talk through. Second thing is income and earnings. And so our average associate dentist is making $120,000 or more per year. and that's kind of what we look for. Again, we're not expecting you to make $250,000 in your associate position, but we do like to see that you're able to produce and you're able to go over that threshold of $120,000 per year. One of the common questions I get around the income and earnings is, well, what happens if I've only been working at my current job for 6 months? Because sometimes you change jobs and you haven't been there for a whole year. And so what I would tell you is that's okay. Typically what we will do is we'll annualize your earnings out for however long you've worked at that current position, and we'll use that number. So student loans, this is the big one. This is where most of the doctors that we deal with and talk to really think that they can't get a loan because of their student loans. And so let me tell you, on average, our average dentist that we're giving a loan to either start or purchase a practice has somewhere between $250,000 to $400,000 in student loans. And guess what? We are okay with that. We're not as concerned with the total amount of student loans that you have as opposed to your monthly payment. So I will give you a pro tip. If you are thinking about practice ownership, it is beneficial for you to have a lower payment than a higher payment. I think oftentimes we hear from new doctors that they just want to take the highest payment possible, pay off the loans as quickly as possible. But that can hurt you when it comes to purchasing and starting a practice. And I'm going to expand on that a little bit as I kind of get through the presentation. So we'll stick a pin in that for now. So in average, student loans, $250,000 to $400,000. Do we see dentists with over $500,000 in student loans? We do. So, and again, we're still doing loans for those dentists, but on average, it's $250,000 to $400,000. Personal debt, it's okay. Most of our dentists are going to have a car, student loans. They're also going to have a home. The key to personal debt here is that you want to try and keep your credit card debt to a minimum. So one of the things that banks don't like, including ourselves, is we would prefer for you not to have, would prefer you to have less than $30,000 worth of credit card debt, which typically is pretty achievable. And then finally, cash savings. Our typical client has somewhere between 7 to 10% of what they're looking to borrow in cash savings. So if you're looking to borrow $500,000, an average, most of our dentists have somewhere between $30,000 to $50,000 saved. And we will want to see that you have some money saved. And again, as I get through the presentation a little bit further, I'm going to expand on that a little bit more. So this is what our typical client looks like. We'll move on here. So next thing is understanding your credit score. I know we're going a little out of place here, but it's important to understand your credit score and what banks are looking for, because that's an important piece of getting a loan. So a couple of things, I'll just start on this slide. First is your credit score is going to range from 300 to 850. In general, banks would like to see you have a 680 credit score or higher. And then finally, you're going to have 3 different scores, and all those scores are going to be different because as you kind of scroll down the page here, you'll see there are 3 credit reporting bureaus. There's Equifax, TransUnion, and Experian. And a little known fact that a lot of people aren't aware of is that they are competitors. So your score is not going to be the same with all of them. It will be different. And in addition to that, what you'll find is that they all score very similar. So your scores will be similar for the most part, but they will be different because they are competitors and they don't share information. And then finally, in the bottom here, as you're looking at these different buckets, this is where I'm going to talk a little bit about how the credit bureaus actually calculate your score. And so this is kind of like the peek behind the curtain. I think everybody is, for the most part, if you've never used or you have a little credit or you haven't had a lot of experience with credit, it's kind of this mythical thing of how the score is calculated. So we'll start from the left here and then we'll work our way over. So the number one thing that affects your credit score is pay history. Pretty easy. Pay your bills on time, your score goes up. Makes sense. The second biggest thing that affects your credit score is the amounts owed. And so let me explain on that, because while it is the second biggest thing that affects your credit score, it's also the thing that most new doctors and dental students have not a lot of clue what it means. And so what amounts owed means is the ratio of what you owe versus what your limits are on your credit cards or your revolving debt. So if you owned a home, you had home equity line of credit, that would count as well. And so if you have, let's say, for example, a credit card that's a $10,000 card and you have a $10,000 balance, so it's maxed out, that looks negative, and that's going to negatively impact your score. The rule of thumb is that you want to have no more than 30% of what your limit is as an ongoing balance on your credit card. Now, it's okay if you charge it up and you pay it off that same month. That I'm not necessarily talking about that. I'm talking about that go forward balance, meaning that the balance that you are carrying on your credit card over a period of time. So you want that to be 30% or less, and then it won't negatively impact your score. Next is length of history. Not much you can do there, aside from just get older, as we all do. Types of credit, 10%. Again, not much you can do there other than, as you grow, and not a big impact there. And then finally, the last one is credit inquiries. What's funny is I think that if I were to ask you or any dentist that I've talked to of the history, what the number one thing that affects their credit score is, I think all of them would say credit inquiries. I don't want you to check my credit. Don't check my credit. And reality is it's the lowest portion of what affects your credit score is the credit inquiries. And so to expand on that a little bit more, another commonly asked question is, well, how does a credit inquiry affect my score when it comes to if I need to shop around banks? And so one of the things I'll tell you is that if you are shopping for a bank loan to, say, purchase a practice, it's okay to talk to a couple different lenders. The credit agencies will actually know that you're shopping for the same type of credit. What has a negative impact is when you're shopping for different types of credit in a short period of time. So if you apply for a credit card, you apply for a student loan, you apply for a car loan, you do all that within a short period of time, say like 3 or 4 weeks, that looks negative because the credit bureau thinks you're being irresponsible, and they believe that you're going to go out and buy all these things and not be able to repay it. So that's a little bit on your credit. I know I didn't answer probably everything I could expound upon in credit, but I wanted to make sure I gave you a basic understanding of how your score is calculated, what banks are looking for, and what our expectations are. And one of the things, just to let you know, is that when you do get a loan or are interested in getting a loan to start or purchase a practice, it is wildly important that you have a good credit score. And so if you don't have a good credit score, your score, you will not get a loan. And that's, again, why it's so important to make sure you keep an eye out on your score. So, all right. Moving off of credit, we're going to dive into purchasing a practice and what that process looks like here. So first thing I want to do is just get into some of the positives and negatives of purchasing a practice. First positive is you get established patient base. You have an immediate income stream. The staff is trained, so they know what they're doing. The insurance providers are already in place. And you can, a lot of times in a practice, have potential to grow. If you're buying it from a dentist who's retiring or has been slowing down, chances are he wasn't doing all the work in the practice that you would normally see a younger dentist like yourself looking to do. And so there's an opportunity for growth there. Negatives. So the staff can be very resistant to change. One of the things that you'll find is that the staff may have been there as long as the dentist. And so Susie at the front desk has been there for 27 years, and Susie at the front desk has been doing things the way she's been trained to do for 27 years. And now, the new doctor comes in and wants to do things a little bit differently or wants to utilize technology different. It is very difficult to do that at the very beginning. And so that's one thing that you'll find is that staff will be resistant to change. You have to change a little bit at a time as opposed to changing everything at once. New owner patient attrition, again, often while it's rare, you can see patient attrition. There's various reasons for that. It could be that your treatment planning different than the old doctor. Again, going back to not being able to change things, you have to really keep things the same. Otherwise, patients will leave. If your treatment planning completely different than the other doctor, the patients are going to be turned off and they'll go somewhere else. The office could be old and dated. I will tell you that when you purchase a practice, the age of the equipment has very little to do with the purchase price. And so there is not a lot of incentive for that doctor to update the practice more than kind of the basics, because it's not gonna make it their practice anymore, worth anymore. So the possibility that you're going to have equipment upgrades, I can tell you that probably 8 out of 10 of our practice purchasers, unless you're buying a practice that had brand new equipment, you will be upgrading your equipment within the first 24 months that you are in the practice. And then finally, you're buying a philosophy. Again, going back to the patient attrition, you need to make sure that your philosophy aligns with the doctor that you're purchasing the practice from. So that's some of the positives and negatives of purchasing a practice. Let's get into purchasing power. And so this screen is really around kind of the look behind the curtain on what do banks look at when we're considering whether or not we want to allow you to purchase a practice. And so it really comes down to these three things: debt, liquidity, and production. And so that with debt, the question is, will the amount of debt that I carry impact me? And the answer is yes. What will affect you is the monthly payments of that debt. Going back to when we talked a couple of slides ago around when we talked about the monthly payment of your student loans, that will have an impact on your ability to purchase that practice. It's very common that we have doctors who want to buy a practice, but if their personal overhead is too much for the cash flow of that practice, well, that can affect their ability to buy it. And I'm going to talk a little bit how that on the next slide and why that is. And then the next thing we're looking at is liquidity. Is the amount, the question there is the amount I have in savings relevant? And so banks, including ourselves, will want you to have between 5 to 10% of what you're looking to borrow in liquid savings. So if you're looking to borrow $1 million, we're going to want you to have somewhere between $50,000 to $100,000. Now, is that a hard and fast rule? It is not. But if you want to borrow $1 million from a bank and you have $10,000 saved, there is a decent chance that we will probably not give you that loan. We want you to have some money saved. And then finally, production. The question here is, how does my production affect my buying power? And it does. The production affects it because loosely, we want to show your ability to be able to produce a similar amount as the dentist that's currently in the practice. And again, using the scenario where you're purchasing a one doctor practice, if that practice is producing $1 million and the dentist is doing $1 million, we would like to see that you can, do close to that number. Now, if you can't do close to that number, that's okay. What we do is then we assume that, let's say you can produce 600,000, but the practice needs $1 million. We assume that you're going to have to pay an associate to do that other 400,000. And so what's that do? That creates an additional expense that we put into the practice when we're calculating whether or not we want to lend to you. And again, just something to take into consideration. That's getting a little into the weeds, but these are the three big things. This in a nutshell is how a bank decides whether or not they're going to lend for you to purchase that practice. All right. So this is, getting back to what we were talking about, debt service coverage. This is really what we look at is, you have income from the practice. I'm going to do a little scenario here at the bottom of the screen. Income from the practice in this scenario is $300,000. We take that income, we divide it by what the annual business and personal debt payments are. So that includes everything personal that you have in addition to a personal expenditure on top of that we factor in. And then, of course, the loan that you'd have to pay to the bank. So in this case, $240,000 is what that number is. We divide those two and we come up with 1.25. And so what's that mean? That means that in this scenario, for every dollar that you have going out, you would have $1.25 coming in. And so that would be a loan that a bank, including ourselves, would make. Because in general, the bank would like to see a 1.2 debt service ratio or higher. And it's pretty much that easy. If you're looking at purchasing a practice, you can look at the income the practice is putting in. Again, there's a lot of additional things that go into that. And then the annual business and payments, divide those two, to come up your debt service coverage ratio. I'm not going to go too much here on how to read tax returns and how you factor that, but at a high level, this is the last two slides is exactly how banks lend. So that's a little peek behind the curtain on what we do from a lending perspective. This is, just gives you an illustration of the building your team. At the beginning of the slide or the beginning of the presentation, we talked about the need to be connected with the right people. So these 5 folks are really the folks that you would need when considering purchasing a practice. So you need a banker in most cases, unless you have somebody that's willing to give you the money for the practice. A lot of times you're going to be dealing with a practice broker simply because around 90% of practices are sold with a broker. It's okay. Brokers are great to deal with. One of the things I would tell you about brokers is that they do represent the seller. So unlike when you're buying a piece of real estate, practice brokers only represent the seller. And so a lot of times your attorney is going to be the person that really helps you through that process. It's going to represent you in the transaction. So it's important to have an attorney, an accountant, and an insurance agent that specialize in your industry. I can't say that enough. I'm going to repeat myself 5 times. You want folks that specialize in your industry. Your brother, the attorney that specializes in corporate M&A, is not going to have any clue how to write up a transaction to help you purchase a practice. Trust me when I say this. So again, build your team. These 5 folks are the folks you would need, and please get the folks that specialize in your industry. Okay, moving along. Next thing is kind of what the process looks like. So let's take a quick look here. First step is get pre-qualified. We have the ability to do that for you. It's a simple conversation with a business development officer that specializes in your industry. Someone from my team or any team in the banking industry would be able to help you with this. Then you want to begin your search for a practice. Identify the opportunities. So once you started looking, you're going to identify what's out there. Once you identify a practice, you're then going to start your due diligence. Once you've completed your due diligence, you at that point would execute a letter of intent. You always want to do a letter of intent before you actually start the contract. So letter of intent is going to lay out the details between you and the seller. And it's going to give you the ability to figure out all the critical details that you agree to prior to actually, prior to really getting too deep. Once you execute the letter of intent, then you want to go for your official approval with the bank. And then finally, once we have you approved, at that point, you got your loan. You're going to work on finalizing the contracts. You sign your closing documents with us and with the seller, and you start your transition. So again, that's high level the steps. I know I went through that kind of quickly, and I'm happy to answer questions at the end that anybody may have about that process. So that's purchasing a practice in a nutshell. Again, about 15-minute crash course there, but happy to go into more detail. And by the way, at the end, if any of you are interested in having a more in-depth conversation, make sure that my contact information is out there. I'm happy to connect you with members of my team wherever you are in the country. So let's talk a little about starting a practice and what that process looks like. So we'll start just like we did with acquisitions. We're going to start with the positives and negatives. Positives of opening a practice: you get to choose your location. Can't stress that enough. Get to customize your layout, all new equipment and technology. Get to hire and train your staff the way you like. You ultimately get to build the culture that you want from day one. Some of the negatives: finding your space can take time. It can. I mean, that's just the reality. You have the stress of construction, beginning with how to patient base. It can take time. You'll have to continue to associate. I can tell you that we absolutely, in a lot of cases, will require that you keep your associate position, at least when you first open up your practice. Because again, when you open up, you'll only be open 1 or 2 days, and you'll still work a couple days in your associate position. And then finally, growing pains with the staff. I mean, you're hiring a staff from scratch. As a first-time business owner and a first-time hiring, you'd love to say that everybody makes the best decision the first time they hire, but the reality is you may make some mistakes. So you may have some growing pains there. So that's kind of the positives and negatives of starting to practice. Let's look at, this is a little glimpse on what building your team looks like and what a team for I started practice. What you can see here is that there is a lot more folks that you would need when you're starting a practice than you do when purchasing a practice. So there is a little bit more. Obviously banker at the top there. We always like to think of ourselves as the most important piece of the puzzle because nothing happens without the money. Banker, and then you have real estate broker. So you need a broker, again, a broker that specializes in your industry, an attorney, an accountant. We just talked about that on the acquisition side, architect, and then a contractor. Obviously, the architect helps draw and make the design, the ability to build it. The contractor is going to build it. An equipment specialist. A lot of times, the equipment specialist is going to be the quarterback of the whole project. They're going to be the ones that help you with the design, help connect you with the contractor. They'll have a technology specialist that will help you with the technology. I mean, let's face it, in today's world in dentistry, everybody wants technology, whether it be a 2D or a 3D cone beam, your digital x-rays, you need computers. There is a whole host of technology that goes into your practice. Marketing company, vitally important. I can tell you that this is probably the area that dentists ignore the most when they start up. A lot of times they end up spending all of their money on the shiny object, which is the equipment and the technology. And at the end, all the money they left over for equipment or for marketing just gets whittled down. But the reality is the marketing money is the most important money that you can have. So if I were to give you one tip, even when you are thinking about purchasing a practice, make sure you keep the money for the marketing. HR consultant, insurance agent. Again, you need a great insurance agent. If you're not familiar, dentistry is the #1 industry for people being disabled. So it's important that you are properly insured. I'll just leave it at that. HR consultant will help you with things such as plan manuals, what you need for your staff to fill out when you hire somebody. You need an employee handbook. All of these things that as a first-time business owner, you probably never thought of. The good thing for you is that there is a whole host of folks in the industry that are there that just specialize in working with dentists that can help you. And we're happy, if or when you're looking to get in that process, myself and my team are happy to connect you with every single person on this page. So that's a little about the team when you're looking to start a practice. Let's go into the process here. So this is similar to purchasing a practice. So the first thing you want to do is get pre-qualified, and we have the ability as a first-time startup, we can approve you for that loan upfront before you even have a space. And I'll talk about what a loan looks like here in just a second. Establish a plan is number 2. Obviously, once you get pre-qualified, you can get the money. Then you want to establish a plan. Where do I want to go? How am I going to go about looking for the space? What town do I want to be in? Once you establish that plan and you establish the size of practice that you want, then you want to establish a budget. Again, you're going to utilize all those folks on the previous slide that we talked through. They're going to help you establish that budget. Once you have the budget, then you officially apply for financing. You're going to find and finalize your location. You're going to finalize your design. And so what I would tell you, another pro tip here, is make sure that you're happy with your design before you sign the lease. And the reason I say that is because so often doctors look at a space and they say, oh, this space is great, and they sign the lease. And then guess what? They go do the design, and they find out that pillar that's in the middle of the space just is going to eliminate 2 of the operatories that they thought they were going to have. So again, something to think about. Just make sure you have a design. All of the major companies, Henry Schein, Patterson, Benco, major 3, have the ability to help you do a design before you sign the lease. So again, just something to keep in mind. Create the marketing plan and start the project. So that's, again, very high level, but gives you an idea of what the steps in the process would be like for starting a practice. All right, so moving on. Next thing we'll talk about is budget breakdown. This is a high level for right now, as a general dentist, our standard approval amounts are $700,000. That's what we're seeing in the market. That has changed significantly since I started doing this 15 or 16 years ago. When I first started, I think we were at 400,000, and now we're up to 700,000. In general, you're probably going to need close to that dollar amount. And so what you'll find here is that we generally divide the money up into three buckets: construction, equipment, and working capital. One of the things that's important is to make sure that the bank that you work with has the ability to section this money off the way that you need it. And so what I mean by that is that, you can see here, for our purposes of this presentation, we have 350,000 in construction, 250,000 in equipment, 100,000 in working capital. But the reality is that's not reality. Your numbers are going to be different. You may need more in construction versus equipment. It's important that you work with a bank that has the ability to do that, and not all banks do. And so I'll newsflash, what I'll tell you is that banks that don't specialize in your industry sometimes have restrictions on how much money you can spend on construction, for example. So just something to keep in mind. I like to make that point when I'm talking through budget. And then finally, on the top of the page here, tenant improvement allowance. That's a term that you should get familiar with. Tenant improvement allowance is the money that the landlord would give you towards the build out of your space. It's an important thing to know because landlords will give you money towards the build out. You don't have to shoulder all of those costs yourself. And I bring that up because dental office build outs, so the construction of a dental office inside a space, is the most expensive construction you can do of any small business out there. So something to keep in mind. All righty. Wow, a lot of info here. I know I'm cramming you full, so I'm happy to answer any questions here. All righty. So next thing is, what should a loan look like? A couple of things. So one, face-to-face contact. You want to make sure that you work with a banker that's local, that has the ability to see you in person, but you also want to work with a bank that specializes in your industry. I can tell you that oftentimes it may be great that your father's had a 30-year relationship with, Bank of Alabama, but Bank of Alabama may have never done a student loan, never done a practice loan before. And so it's important as a dentist, your needs for capital when you're starting or purchasing a practice are different than any other small business out there. And so when you go to a bank that doesn't specialize in your industry, they're going to treat you just like they treat the dry cleaner or the pizza shop. And oftentimes that can spell disaster when it comes to getting the loan. So industry experts, you want to make sure you have those industry experts. Fixed rate, you should always have a fixed rate. You should not have an adjustable rate on your loan. 100% financing, you should get, this is another red flag if you have a bank that says, no, we won't give you 100% financing. As a dentist, one of the great things about your industry, and because of all the dentists before you that have started or purchased a practice and done so well, you have the ability to finance all of that practice without any money out of your pocket. So 100% financing is something that you should receive in almost all cases. And not only should you get 100% financing, we will give you working capital on top of the 100% financing. Flexible terms. As a first-time business owner, you need those longer terms. So oftentimes local banks will want you to pay the loan back in 5 or 7 years, and that can be a challenge as a first-time business owner. So with the specialty lenders, you want those terms that can go out 10, 12, or even 15 years when you're looking to start or purchase your first practice. You want low fees. If a bank comes to you and says, listen, our fee is $5,000, you should be wary of that. Most specialty lenders like ourselves, the fees for the loan are going to be under $1,000 total, if that. And in some cases, we have promotions where you pay almost nothing in fees. So personal collateral, you should not be giving any personal collateral. You will have to sign personally, so you'll have a personal guarantee. But if they're asking to give your house as collateral or your car as collateral or anything as collateral, you should not be doing that. So that's something you should be wary of. And then finally, future growth. It's important that bank gives the ability for you to be able to grow in the future. Maybe you want to own a second practice. Maybe you want to own 10 practices. Will that bank lend to you? And the reason I bring that up is that the bank that does your first loan is the bank that needs to do your second or third loan as long as you have that debt. And so it's very important that you're looking into the future and that you're making the decision with the bank that you want to do business with based on what your plans are, not only today, but in the future. And so that's a little what a loan should look like. One more slide, and we're gonna take this plane for a landing, and we'll open it up to questions. And so finally, this is just a little about the life cycle of business ownership as kind of we see it here at the bank. And I'll just kind of briefly go through this. You have, when you're first starting, it's really about managing your cash flow and, making sure that you can, bank the way you need to. So you're starting your business, you're establishing your culture, you're growing your client base. And then, after that first 3 years, the next 5 years of ownership is really about expanding your services, increasing your staffing, growing your revenue. You're really kind of hitting your stride. So you're focusing on your employees, you're improving your business. So the first couple of years, you're just kind of fumbling through it, but that next 5 years, you're really you're honing things down or in. And then that next 10 years is really where your peak, right? So when you're after the first 8 years, the 10 years that you're in practice during, that's when you're managing your profits. You're really starting to think about the long-term things. How do I maximize my cash flow? How do I make sure that I'm saving for retirement properly? Am I streamlining my cash flow the way I should? And you really, maybe start to think about, what does it look like for me to exit? What do I want that to look like? And the reason I bring that up is that, you need to start planning 5 years out from when you want to transition your practice. And so it's never too early to start thinking about, the future, what the future looks like, how long you want to be in practice for. You may not know that answer, especially for the dental students here today. You may say, God, I just want to get a job and I'll figure out how to purchase or start up a practice at some point, but it's great to know that I can do it. So my point in putting this up here is just to give you an idea of what that looks like in the long term, and that you can do it. So, all right. So finally, the decision. I love this quote at the top of the page so much. If you don't build your own practice, someone will hire you to build theirs. Isn't that the truth? And for those of you who are still in dental school, the people recruiting you, the DSOs, are probably not going to tell you this, but that's the reality. Is you're either building somebody else's or you're building your own. So really, what's the decision come down to as an associate? Obviously, you're not able to practice dentistry your way. There's no ownership, but there are no ownership responsibilities. You have a steady income. Earnings potential is likely capped. No equity position in the business. As an owner, you can create your own culture. You get to protect your profession, which may not seem like a big deal now, but as you get into practice, you will realize it is a huge deal. You control your own destiny. You really have no income ceiling. You can make as much money as you have the ability to grow your practice, and you have the ability to affect your community. So I will, in ending, I will tell you, thank you all for your time. I hope you found this beneficial. I am more than happy to answer any questions, and thank you again for being on today.